Welcome to this video. In this video, we are going to discuss about receivable policy. This question was asked in December 2012 exam. So we'll start from the required. The required states, calculate the net benefit or cost of the proposed change in trade receivable policy and comment on your findings. So this is a 6-mark question. So we'll find out the proposed change. So we'll start to work out. So we'll read the question. KXP is an e-business which trades solely over the internet. In the last year, the company had sales of 15 million. All sales were on 30 days credit to commercial customers. Extracts from the company's most recent financial statement position relating to working capital are as follows. So they have given trade receivables, trade payables, and overdraft. So in order to encourage customers to pay on time, KCO proposes introducing an early settlement discount of 1% for payment within 30 days, while increasing its normal credit period to 45 days. It is expected that on average 50% of the customers will take the discount and pay within 30 days, 30% of the customers will pay after 45 days, and 20% of the customers will not change their current paying behavior. KXP Co currently orders 15,000 units per month of product Z. So I think this paragraph is given for the requirement B. So we will leave this. And finally, KXB Co has an overdraft facility charging interest of 6% per year. So these are the information that we want. We don't want this one. This is for the EOQ or the requirement B. So we'll leave this. We'll start from this question. So what we'll do is we'll start from a format which has already I've prepared. We'll start from this requirement A, receivable policy. So there are like two policies here. One is the existing policy, and the other one is the proposed policy. So we'll find out what's the cost of the existing policy here. See, the existing policy, what happens is we are having a lot of sales. Okay, we are having a lot of credit sales, and with this credit sales, we are trying to give 30 days of credit to our customers, but we are not sure like how many days of credit they take. So first what we'll find out how many days they are taking to pay the credit. So the formula works like this: 365 into the trade receivable divided by the credit sales. So that's the formula. This formula will give you the current trade receivable days. So we'll start. So 365 into trade receivables. Trade receivables is 2466 divided by the sales. So sales is 15 million. So first we'll find out like what is the 15 million in our terms, or in we have to work out sales in terms of 1000. So credit sales is 15 million and we want it in terms of 1000. So the answer comes to 15,000. So this number we have to divide it by 15,000. So we will get the days here. So it is 60 days. So the current trading days is 60. So first we will do it for that. So we have 60 credit days divided by 360 days into the credit sales. Credit sales is 15,000. This will give you the receivables part. So this receivables we have to pay an interest. So the interest they have mentioning here that the overdraft interest is 6%. So we'll have 6% here. So this will give us our answer. So our answer comes to 150. All these numbers are in terms of 1000. If you want, you can put that. This is about the interest on the trade receivables with using the current policy. So we'll now move on to the new policy. So the new policy works like this. We'll start. So the discount that the customers will get is 1%, and how many of them are going to accept this? Only 50% of the customers are going to accept this, and that multiplied by the sales. So these people are the ones who are going to get this discount. 50% of the credit customers, for them only 1% is going to be given. So the next one is the interest on the trade receivable. So we can copy this and we can use the same. We should start. So it says 50% of the customers will take the discount and will pay within 30 days. 50% of the customers are going to accept this and they will be like paying in 30 days. So we'll get the answer for this. And there are going to be other customers. So other customers, 30% of the customers will pay after 45 days. So we'll take it as 30% of the customers will take 45 days, and finally 20% of the customers will not change their current paying behavior. So 20% of the customers will not change their behavior. So if they don't change their behavior, they're going to pay only in the current existing policy of 60 days. So that's about the three numbers here. So we can just copy them all and we can put it here. So we'll just add equal. So we got the answer. So the answer comes to 176.25. So is it a savings or is it a expense? See, all these numbers are in terms of cost. So the old cost was 150 and the new cost is 176.25. So it is an additional, it's an additional cost from the proposed policy would be the new cost minus the old cost put together. So that's about this question. So what is our suggestion? The suggestion is, as the proposed policy is more costly than the existing policy, we can reject it. So once you have given a suggestion, the question is over. So now we'll move on to the next problem. So the next question is early settlement discount policy. So this question was asked in December 2015. So we'll start from the requirement. So the requirement A is evaluate whether ZCO should introduce the early settlement discount. So we'll start. ZCO currently has an income of 30 million per year, of which 80% is credit sales and a net profit margin of 10%. Due to fierce competition, ZCO has lost market share and is looking for ways to win back former customers and to keep the loyalty of existing customers. The sales director has pointed out that a major competitor of ZCO currently offers an early settlement discount of 0.5% for settlement within 30 days, while ZCO itself does not offer any an early settlement discount. He suggests that if ZCO could match this early settlement discount, annual income from credit sales would increase by 20%. So credit customers of ZCO take an average of 51 days to settle the invoices. Approximately 0.5% of the company's credit sales have historically become bad debits each year and written off as irrecoverable. The finance director has been advised that offering an early settlement discount of 0.5% for payment within 30 days would increase administration cost by 35,000, while 75% of the customers would be likely to take the discount. The credit controller believes that bad debits would fall to 0.375 of credit sales if the early settlement discount were introduced. ZCO has an average short-term cost of finance of 4%. Assume that there are 360 days in a year. So that's about the question. So again, it is a existing policy and a proposed policy. But this question differs because it says there is a profit and that profit will increase because of this proposed policy. So we are not only going to find out the cost, but we also have to find out the increased profitability from the existing policy to the proposed policy. So we'll start from a format. So this is a format which I have created. So once you have read the question, your format will keep evolving because these problems do not have a perfect format like how we had in net present value sum. So what happens is, as per the question, you have to evolve your format. So that's how it works. We'll start. So the current policy will have these costs: the cost of finance, the bad debits, and finally we'll total the cost. And the proposed policy has a lot of items here, so we'll incur that. And we'll also work out whether there's a benefit from the proposed policy to compare to the old policy, and we'll also have some working notes. So we'll start. So we'll start from the existing credit sales. So the existing credit sales is 30 million into 80%. So we need this number to find out our cost of finance. So how does a cost of finance work? So a cost of finance is, we have 24 million of sales, credit sales, and this is going to be like in receivable terms. Receivables is going to be 51 days, 360 days is the year. So this will give our receivable. Multiply this with the cost of finance. So the cost of finance is 4%. So this will be like giving us our cost of finance. And we'll move on to the bad debits. The bad debits, existing bad debits are going to work as approximately 0.5% of the company's credit sales have been historically become bad debits. So our bad debits is 0.5% of the credit sales. So credit sales is 24. So that's how it works. And if we solve this, we'll get the total cost. So our total cost will be this number plus this number. It comes to 0.256. This is a cost. So as it is a cost, we can have a minus symbol before it. So it's a cost, so we'll have it as minus 0.256. So that's about this cost. So we'll start from these costs. So in the proposed policy, first we'll find out the increased profit, because they say that because if we are going to introduce early settlement discount, the sales will increase. So that has been given here. He suggests that if the ZCO could match this early settlement discount, annual income from trade sales would increase by 20%. So our sales would go up by 20%. So we'll take it as into 120 percentage. Okay, we will add the percentage. So that comes to 28.8. So the existing profit we need to know. So that is this number into 10%. We got our existing profit. We can copy the same and we can find out for the proposed profit. So proposed profit is 2.88, and the increase in the profit would be this number minus this number. So we got 0.48. This 0.48 is a positive number as it is a profit, 0.48. So we'll find out the next items. So the next item that we have to work out is the cost of finance, ESD. So early settlement discount. So the early settlement discount, they say that the finance director has been advised that offering an early settlement discount of 0.5% for payment within 30 days would increase the administration cost by 35,000, while 75% of the credit customers would likely to take the discount. So we'll start. If we are going to give the early settlement discount, people will take 30 days to make the payment. So we have to find out what is the cost for 30 days. So we'll take the earlier formula. So we'll do the sales will change from this number to a new number 28.8. The number of days taken will change from 51 days to 30 days. That's it. We will get this number. But not, the question is, not all people are going to accept this. So what happens is only 75% of the customers are going to accept it. So not all are going to accept this. That is going to be a problem. So if 75% are accepting this, what does the remaining people do? So the remaining people, we have to again calculate their finance. So 25% of the credit customers are not going to accept this. So how many days will they take? If, as per this problem or any problem, if only certain set of people are going to accept the 30 days policy, the other people are assumed to follow the old policy of 51 days. Okay, so that's about the interest. So now we'll find out the bad debits. So the bad debits, they say the credit controller believes that bad debits would fall to 0.375 of credit. So we already have a credit sales calculation. We'll copy that. We'll paste. So the cost is going to change. It's going to be 375, and the sales number is not going to be 24. It's going to be 28.8, and we'll start from the early settlement discount. So early settlement discount, we can copy this and we can do. So early settlement discount, out of the 28.8 of sales, 75% of the customers are going to accept this. Okay, so we don't need to calculate the days for this or the interest. What we have to calculate is, for the entire 28.8 into 75% of the credit customers, we are going to give how much of early settlement discount? We are going to give 0.5% of early settlement discount. So that is going to be the early settlement discount part. The next one is administration cost. So administration cost could be in terms of 35,000 per year. So we'll mark it here. So it's a minus 35,000 per year, but we have to do it in terms of millions. So we got the millions. So this is our million, and that's it. We will have to get our sum. So our sum will be an addition of all these numbers. So we have to be like careful regarding the whether it's going to be a plus number or a minus number here. So what we'll do is, as this cost is a interest is a negative number, we'll take it as a negative number here. Okay, so we can copy all of this and we can just paste it here. So we'll get the answer. So we got our answer. So our incremental profit, okay, the profit is going to be 0.116. We are, in the earlier one we only had cost, but in our proposed policy we are getting a profit. So that is actually a very good one. So the benefit from the proposed policy when compared to the old policy is, we can work it out here. So this is our income minus this number. So we'll get a much higher number. So this will be our answer here. Why is this an answer? Because we not only make a profit when compared to the existing policy, we also decrease that cost. So the decrease of that cost and the increase of this profit will leads us to a higher number. So we can either show it as in decimal millions, or we can also work it out in terms of the million itself. So we can multiply by millions. So we got this number. So this is the answer for this question. So ensure that you do the symbols like properly. So if you put the minus here itself, it's much more better. You will get the minus answer here. And ensure that you also do this properly, because the first number alone is a positive number. From there on, all of them are a cost. So ensure that you do it correctly, because even if you miss a single number, your answer would be very different. So that's about this problem. So we'll move on to the next sum. So we'll start from this sum. So this sum is going to deal with factor, and it's taken from a textbook, so it's not coming from an exam. So we'll start with the question. CD has annual sales revenue of 2,07,500 and trade receivables of 3,30,000, which represents 60 days sales based on a 365 day year. Sales and trade receivables are expected to continue at the same level for the next year. CD pays interest on its overdraft at a rate of 10% per annum. So that is the overdraft rate. So CD is considering the use of non-recourse factoring. So what is non-recourse factoring? If the trade receivables have been sold, okay, the company will not receive the trade receivables. It is the headache of the factoring company. The factor will pay 80% of the trade receivable when a credit sale is made, and the remaining 20% when the cash is received from the customer. It is estimated that as a result of the factor's expertise, cash will be received from the customer in 50 days. So whether the 50 days, the factor will charge interest rate at a rate of 12% per annum on cash advance and a fee of 2% of annual sales revenue. So that is the fee part. CD estimates that credit cost control costs will get reduced by 30,000. So that is a benefit for the company. So we'll start. So we'll work out this entire sum in terms of the given numbers itself. We're not going to convert into thousands or millions. We'll directly work it out. So the company has a total of 2,07,500. So this number is going to be with the company as a credit sales for 60 days divided by 365 days in a year. And this has to be financed by the company. So the company will be using a negative 10% of overdraft. So that's about the number. So there is no other numbers which are like for the current policy. So we can directly take that and we can solve it. So we got 33,000 negative. So what is the total? The total cost of the existing finance is 33,000. So we'll move on to the proposed cost. So the proposed cost has like several variables here, and we have to work out one by one. So the first one is the cost of finance, which is like given by the factor. We'll copy this number so that it is easier to work out. Okay. So the sales is going to remain the same, but the factor will give us our payment and receive the payment from the customer in 50 days time rather than the 60 days. So our receivable will be only for 50 days, but the factor will not charge 10%. He will charge 12%. So we have to change that 12%, and we won't get finance for this entire amount. Okay, we'll get finance only for 80% of this amount. That's what he says. The factor will pay 80% of the trade receivable when a credit sale is made. So he will pay only 80%. So 80% of the credit sale for 50 days, he will give us at an interest of 12%. The balance 80% is, should we take care of it or will he take care of it? The answer is he will take care of it, because either the customer pays or doesn't pay, he will pay us this amount. But the thing is, this amount, okay, this 20% balance amount, he won't pay it immediately from his pocket. He will wait and he will pay in the 50 days time. Okay? Even though they turn out as bad debits, he will pay us in 50 days. But this has to be financed by us, and our finance cost is 10%. So that's about this element. So the next item is the factor fee. So the factor will take a fee for managing all this, and it's going to be a fee of 2% of the annual sales revenue. So he will take 2% of the sales revenue. That's going to be 2,700. So he'll take this amount as his fee, and we have a reduction in admin cost. So as it is a reduction in admin cost, okay, we'll have a plus 30,000. So our cost gets reduced, so it's a plus 30,000. Factor fee is a negative, okay, factor fee is a negative number. So if you want, we'll adjust it into -1. We'll take it as into -1 so that it is gets adjusted as a negative number. So we'll go to the amount column. So here we'll take it as equal. So we'll take a sum. So our sum is going to be 40,050. So what happens here? The cost actually goes up, okay? So it's going to be how much? Earlier we had 30,000, 33,000. Now it's going up by another 9,050. So we can give a suggestion. So the suggestion can be, as the proposed policy is costly, we can reject it. So you can put it as bold, and if you want, you can take it like one sentence down. So that's about it. So if you want, you can bold certain items so that it looks neat. So that's about it. So when you do these sums, ensure that all costs are in negative. If you can't do a negative number somewhere, okay, multiply it by -1 so that it comes to a negative number. Because if you put a minus symbol before, it then takes this as itself as a formula. So I'll just put a negative number here. You see, it takes it as a formula, so that doesn't work. So that's why we'll put a minus symbol at the end, so that you can easily get all the numbers in negative. Okay, so that's about this problem. We'll move on to the next problem. So we'll start. This is another kind of a factor problem. So it is from a textbook, and we'll start from the required. The required itself is two parts, requirement A and requirement B. So we'll start from the question from the beginning. Eden is a medium-sized company producing a range of engineering products which it sells to wholesale distributors. Its sales have recently begun to rise rapidly due to economic recovery. However, it is concerned about its liquidity position and is looking at ways of improving the cash flow. Its sales are 16 million per annum and the average receivables are 3.3, representing about 75 days of sales. One way of speeding up the collection process from receivable is to use a factor. So determine the relative cost and benefit of using the factor in each of the following scenarios. The first case, so we'll read this case and we'll do the sum. The factor will operate on a service only basis, administering and collecting payment from Eden's customers. This is expected to generate administrative savings of 1 lakh per year. The factor has undertaken to pay outstanding debits after 45 days, regardless of whether the customers have actually paid or not. The factor will make a service charge of 1.75 of Eden's turnover, and Eden can borrow at an interest rate of 8%. So they have given us a lot of information here. So this factoring actually is a part of non-recourse factoring. So that is financing option 1. So the amount that we are going to use is the actual amount which is like given in the sum. So that's how we are going to do. So we'll start from the cost of finance. So the cost of finance works like this. We have 16 million. 16 million. This is going to be with the company for 75 days as receivables. So the total number of days in a year, it's not given. So we can assume it to be 365. If they have not given anything, we are free to assume any day. We'll take it as 365 days. So we'll use this Eden can borrow at an interest of 8%. We'll use the same number. So we'll take it as 8, or we'll better take it as minus 8. So this will give us the existing option cost. So that's about this number. So the next one is the factoring. So the cost of factoring. So the cost of factoring is like similar to what we do, but here certain information changes. So the sales information is the same, but the receivable information is not 75 days. The factor will pay us in 45 days, and they say that irrespective, okay, and they say here customers have actually paid or not, the factor company will pay us in 45 days. So that we will take. The cost of financing, there is no separate cost of financing for factor. So we'll use the same 8%. Okay. So we can use that number. And next we'll move on to the savings in administration cost. This is expected to generate administration savings of 1 lakh. So 1 lakh is a positive number. So the next one is the factor fee. So the factor fee is 1.75% of the turnover. So we'll take this number and we can simply multiply. Of the sales, the factor will take 1.75 as the fee. So we can copy and we can now do the answer. We'll get the sum of all this. So the sum comes to 3,37,808. So what is the additional factor cost? So additional factor cost is this number minus the existing finance cost. So we'll get the answer. So the answer comes to 74,794. So that's about the additional cost of factor in option 1. So now we'll move on to the option 2. So option 2 says it is now considering a factoring arrangement with a different factor where 80% of the book value of invoices is paid immediately with finance costs charged on the advance at 10% per annum. Suppose that this factor will charge 1% of sales as their fee for managing the sales ledger, that there will be administrative savings of 1 lakh as before, but that outstanding balances will be paid after 75 days. So they say that this is going to be with recourse factoring. That is, if the customers don't pay, then the factor will not be responsible. He will send that bills to the company and the company has to chase them. So it says the factor will make an immediate payment and will charge for 45 days. So here in the second factoring, it doesn't work like in the first factoring. In the first factoring, that is non-recourse, in 45 days the factor will collect the receivables and he will give it to the company. But here this factoring will take 75 days to collect it. So that's what he says, but that outstanding balances will be paid after 75 days. That is, there is no change in the typical payment pattern by customers this time. So the customers will take 75 days of time. So we'll copy the first sentence and we'll use that. So if the factoring is going to take care of this book, he will charge how much? He won't charge 8%, he will charge 10%, but he will give 80% of that finance immediately. So 80% of the book value he will pay immediately. Okay, so it works like this: 80% of the trade receivables he will give. Okay, and for 75 days he will take the collection period and he will charge 10% as the interest for the amount given. The next one is own finance. So if he pays the 80%, the balance 20% has to be financed by us. So the balance 20% we have to arrange finance for 75 days, but our financing cost is much less. It's only 8%, because that is what is given here. Eden can borrow at an interest rate of 8%. So this is how it works. The savings in admin cost is going to be the same, 1 lakh, and the factor fee is going to be 1%. So we have already done a factor fee here. We can copy it and we can use it. So the factor fee is going to be just 1%. So that's it. We can use all these numbers and we can get the answer. So we can get an answer. We can just sum it. So this is our answer, and we also have to find out the additional cost of factoring. So comparing this option and our this option and our current policy option. So this will give us our answer. So the answer comes to again a negative of 1,12,000. So we can put it like this: both. So the suggestion will be both factoring are costly and hence can be rejected, but if the company feels liquidity is more important than profitability, then they can consider option 1 factoring. Some companies feel that it's better to have more liquidity than the profitability, so they can choose this option, because in this option the cost is only like around 75,000 additional cost, but they get immediate liquidity. So there is a benefit and a trade-off. So a company has to consider these points before finding out whether they have to go for a factoring or not. So that's about this problem. We'll move on to the next one.